A very good evening to all of you. Welcome to another YouTube live session with me, Srujit Kakkar. Today is Monday, 30th of December 2019, and today we are going to talk about price action trading. Now, before we get into price action trading, let's quickly get done with the formalities. So make sure that if you're watching it live, you can pause the live stream, go through the disclosure. If you're watching it as a recorded session, you can still do the same thing, pause it, go through the risk disclosure. I have 2 pages, so I'll keep these pages for a few seconds so that it's easier for you to pause it and go through the disclosure. And I'm pretty sure if you have been watching my sessions for the last few weeks, probably would have already gone through these disclosures by now. So let's get started, and what I'll do is I'll bring up the chart and we'll start with the charts. Just give me a second, and there we have the charts. Perfect. So today what we'll be doing is we'll be talking about what is price action trading, and after understanding price action trading, I'll be going one step ahead, because if you look at the topic says uncovering the secrets of price action. So how we'll be uncovering, it's not that I'll be telling you the advantages of it, I will be uncovering the disadvantage of it, right? So even though yes, price action has its own advantage, in fact, what I'll say is, even when I apply demand and supply trading, I'm also using price action. But basically when I'm talking about price action, I will be comparing the demand and supply version of price action versus what the conventional technical analysis people they use, and how even in price action, demand and supply definitely has an edge over probably any other methodology you're using. So the first thing to understand is that what is price action trading. So what I'll do is I'll just bring up some white space so that we can draw, right? So probably what I can do is I can shift it to the left so that we have some white space to draw. So the first thing is, what is price action trading? Now, price action trading refers to a style of trading where you are not using any mathematical calculations. Now, what are these mathematical calculations? These are your indicators, your oscillators, because all these indicators, oscillators, they get calculated using price action, right? So if you are looking at some indicators, you are looking at something which will always be lagging, because these indicators are always getting calculated from whatever is happening on the chart. So a person who is not using any indicators like moving averages, trend lines, Fibonacci's, whatever it might be, not using any oscillators like RSI, CCI, stochastics, Bollinger Bands, right? All those things. So a person who is not applying any of those indicators to the chart, and just by looking at the flow of the price, like here I can see how the prices have been flowing, so this is what we call as price action. So a person who is trying to identify the trading opportunities just by understanding this naked chart without any indicators, without any oscillators, that style of trading is basically called as your price action trading. Now, talking about price action trading, the first thing we need to understand is why we would like to use it, because price action is always real time. So can you see, whenever a transaction is happening on the chart, that is shown to us by these candles, right? If you're using a candlestick chart, if you're using a line chart, yes, the line chart is also showing you whatever is happening on the chart, but this is real time. It is showing you the real transactions as and when they are happening on the chart. But if you talk about indicator, the value of the indicator is always calculated based on historic data. Now I'll give you a very simple example. What we'll do is, just to show you that the indicators, they do not give you any edge. Let's take an example. I know a lot of people, they use moving averages. So let's just apply, let's pick anything. Okay, let's take maybe Nifty, right? So let's take Nifty. Let's go to the daily chart. And what I'll do is I'll apply 2 moving averages, and we'll randomly choose the period of those 2 moving averages. One will take a very short period, maybe something between 0 and 20. The other one will take maybe something between 20 and 50. So you let me know in the chat box, out of 0 and 20, any number, right? So give me any number. By the time, let me add some moving averages. MOVING moving average. Doesn't matter whether you apply exponential or the simple moving average, doesn't make any difference. So just give me any number between 0 and 20, and then give me any number between let's say 20 and 50, right? So just give me any 2 numbers. Between 0 and 20, and then between 20 and 50. So just give me 2 numbers. I want a fast moving average and the other one I'll be using as a slow moving average. So I'll wait for your replies. I'm looking into the chat box. I know the chat is always, the video is always a little delayed, probably by 15-20 seconds. So by the time I start getting your replies, it's going to take me another 15-20 seconds. So I got 20, okay, and between 20 and 50, right? So the first answer was Sridhar, he said 20. So what I'll do is I'll change the very first moving average to 20. And Hira Singh, I will also be doing this session in Hindi, which is going to be tomorrow. So what I'm doing is I'm taking a specific topic. One day I'm doing it in English, the second day I'm doing it in Hindi. So today we are doing this session in English. Tomorrow we'll be doing the same topic in Hindi as well. So not to worry about it. Okay, so I got 20 and 16. So again, 20 and 16 are very close by, right? So give me something between 20 and 50, right? So I've already taken 20 because that is the first answer I got. Okay, next one I got is 50. So let's take it as 50. So let's put one as 20 and the other one as 50. Now, why am I doing this? Because you would have seen a lot of people will show you different strategies, right? And whenever you back test those strategies, they look picture perfect. Now, can you see I didn't select any numbers. I asked you to give me any random numbers. And now if you look at this strategy, can you see we had a crossover, and after crossover we had a beautiful move to the downside. So best looking strategy which probably you can use to plan your trades. So what I'm trying to show you here is that if you're using some indicators, what are the disadvantages? The disadvantages, even if I'm using any random number and in back testing it looks perfect. Here you see you have again a crossover, and can you see after that crossover we had an amazing move. Probably this is something I can always use. Again you had a crossover, we had an amazing move. Again you had a crossover, you got an amazing move. Again you can see you had a crossover and prices started moving down. Again you had a crossover, prices started moving up. Again a crossover, prices started moving down. So can you see when we are going to the past and we are applying any of these strategies, any of these indicators or any of these mathematical calculation, like I said, all these mathematical calculations are getting calculated from whatever has happened on the chart. So that is the reason, irrespective what random numbers I use, you will see majority of the times they will look like perfect strategies. Why? Because the indicators have already adjusted themselves to whatever has happened on the chart, which is your price action. So that is the reason why we should first be avoiding a lot of indicators and focusing more on price action. Why? Because price action is always real time. These indicators, they are always lagging. These indicators, they always adjust themselves to what is happening on the chart. So that is why when you apply even some random numbers, can you see in back testing they look beautiful. But I'm pretty sure many of you would have tried such strategies which look very beautiful in back testing, but when you start applying it to real markets, they don't work, right? The reason is because in real markets, the indicators are not trying to predict what is going to happen in the future. The indicators are always showing you what has happened in the past. So that is what you need to understand. We believe in a way that probably the indicators are predicting the future. So the indicator is not predicting futures. The indicators are only showing you what has happened in the past. And because they will only show you what has happened in the past, yes, they would always be in sync with the price action. That is the reason when you do that back testing, they look like some of the best strategies to be used. But like I said, in real life, they go for a toss. So that is reason number one why we should not be using these indicators and we should be more focused on price action. Because if you think about it, something which price action is already showing you, why do you want to see the same thing by using indicators? Because indicators would also show you what has happened in the past, right? But price action is already showing you, so it doesn't give you any edge, right? So that is the first thing, that why it is very important for us to have more emphasis, to put more emphasis, or we should be planning our trades more based on price action versus using these indicators. Because the biggest challenge with us as traders when we initially start is that we believe that the indicators, they predict the future. The indicators, again I'll say, they do not predict the future. They only tell you what has happened in the past. And can you see that is what these indicators are showing me. I'm just taking random numbers working beautifully. And especially if somebody is coming to you and selling these strategies, what they will be doing is they will be further fine-tuning it to ensure that it looks very beautiful on the chart, right? So they will even try to tweak it a little bit. Maybe instead of 20 they'll go for 22, 23. So they'll randomly check some numbers, see which one gives the better results, and that is what then they start selling as a trading system, right? So first thing, don't believe in any indicators, don't believe in any oscillators as far as back testing is concerned. because the fact is, in backtesting, the indicators, the oscillators have already adjusted themselves to what has happened on the chart, right? That is why you will never see me using any indicators when I plan my trades. My trades are planned purely based on price action, right? So that is where, you know, we have the first reason why price action is much more important versus using any of the indicators. So now let me remove these indicators, because now we understand these indicators, they have no meaning. And then we'll move to the next step. Perfect. So like I talked about, that yes, price action is basically understanding the movement of price on the chart and making your trading decisions based on that. Why we do not use indicators, we also touched upon it. But yes, before I move forward, let me also add here that these sessions which I'm doing, I'm trying to do probably 4 to 5 sessions every week. The timings for these sessions are not predefined other than the Sunday session. So to get notified when this session is happening, make sure you subscribe to my channel, hit the bell icon, because I start the timer 10-15 minutes before the session starts. That way you will get notified when the session is about to start and you can join the session live, right? So make sure you do that. And yes, if you're liking these sessions, do let me know in the comment box what topics you want me to take. I'll definitely take those topics, share it with your friends. If you are on some trading groups, share on those trading groups. Maybe some people have some questions, they can put it in the comment section, then I can take those questions as the topics in the next coming few sessions. Alright, so now that we are done with what is price action trading, we are also done with, right, so I have all these things noted down, what all I wanted to cover. So we've also talked about why we should not be using indicators, because I just showed you a beautiful example that we just took some random numbers. I didn't even select those numbers, you people gave me those numbers. You can try it out on as many charts as you wish to. You will see anytime you take 2 random numbers, you know, they will work beautifully, right? If not, but every time, majority of the time, right? And that is where you need to understand and realize that these indicators are getting adjusted to what has happened on the chart. They were not predicting, they are just adjusting themselves to what has already happened on the chart. So now coming to the next point, that because I don't want to use indicators, I don't want to use oscillators, now I want to plan my trades using price action. So what you need to do is you need to have a blueprint, right? You need to have a rule-based process that if I am using price action to identify my trading opportunities, how I'm gonna do that, right? I'll give you 2 different examples. But before we do that, let me give you an analogy. So let's imagine you are constructing your home, right? So if you're constructing your home, you cannot do something like this, that randomly this is where I'll put the bedroom, this is where the kitchen will go, this is where the bathroom will go, right? So what you do is you go to a person who would plan it for you. He'll create a blueprint for you and show you that this is how it has to be done. And that is when the construction starts, because everything has to go step by step in a very planned way. You cannot start doing something in a random fashion. So similarly, when it comes to price action trading, you need to have a rule-based strategy for you, that this is what I'm looking for, and only if I find this on the chart, then it becomes as my trading opportunity. If I don't find this, probably I don't have a trading opportunity on the chart. So what I'll do is I'll show you 2 different ways to do it. Now, do I use those methodologies? Absolutely not, right? Like I already said, I also use price action, but my methodology of understanding price action is by understanding the areas of demand and supply. I'm not using anything else, and I'll also give you some reasons why demand and supply has advantage versus anything else you're doing in conventional technical analysis. So the first example can be, everyone understands that when it comes to the markets, in conventional technical analysis, it is believed the markets are or can be in just 4 different phases. Just give me a second. Okay, so now my drawing tool is working. So markets can be in 4 different phases. What are those 4 different phases? You have accumulation, where probably the big boys are accumulating scripts or a lot of stocks. After that accumulation phase, what happens is markup, where prices, they start moving up. And this is where that emotion of greed starts coming into the market, and everyone now wants to jump in and wants to buy. And now when everyone is happy buying at those expensive prices, what happens is the distribution. The people who bought at those cheap prices are now distributing at those expensive prices. So this is your accumulation. You have your markup, where the prices are moving higher and higher. Then you have the distribution phase, and after that you have the markdown, right, where again prices, they start moving down and come to cheaper prices. And this is where people, they again start panicking and they start selling at cheaper prices. And when they start selling at cheaper prices, again those big boys are happy accumulating at those cheap price. again the cycle goes on, and this is how the market works, right? So you have your accumulation, you have your markup, you have your distribution, and your markdown. So one way of understanding price action or planning your trades can be by using this concept of 4 different phases of market. So trying to understand by looking at the chart whether we are in a markup phase or whether we are in a markdown phase, or are we in accumulation phase or are we in a distribution phase. So let's take an example. All right, let's pick some examples. So if you look at example, let's say we'll take Nifty. So if you look at Nifty, you can clearly see as if now we can say that this is a markup phase, because every time you look at the chart, prices, they are just making new highs, new highs and new highs. Oops, just give me a second. This was too big. Perfect. So can you see now as if now we are in a phase where we call it as markup, right? Prices have been moving up. So what do we do in that markup phase? Like you have seen me talking many times in the previous sessions, the Sunday sessions especially, I always talk about that whenever we are in such a phase, I don't look for shorting opportunities, I only look for long opportunities. So what I would be interested in, I would be waiting for some corrections to happen so that prices, they come to some demand areas, and those can be my opportunities to go long in this phase. Now I also talked about that I have certain conditions which I look for, and when I see those conditions, those are my criterias. Even if you want to, even if I want to plan a short trade, I can do that. So can you see, for that also I have certain rules. But now again, if you look at the same thing, which is right here, when the prices, they started moving down, probably prices might have come to some demand area which would have maybe given you the opportunity again to participate with this move to the upside. So that is one way you can try to understand that what is the phase of that particular market as of now. Let's take another example. So can you see, this is a very beautiful example of S&P 500. Now can you see, if you go through the Sunday session, on the Sunday session I marked this as a supply zone for you, and I told you that yes, this would be a very aggressive trade, but if you want to plan a trade, you can still do that. And can you see what happened today? Prices came to that area once, we got a bounce, came to that area the second time, we got a bigger bounce, came to that area now for the third time, and can you see an amazing move from this area. Now this is a zone which we just planned yesterday, which is Sunday, and can you see today it worked out not just once, it worked out once, twice, thrice. And this also brings us back to one of the topic where I talked about that your areas of supply create your area of resistance. Can you see, at this point of time it was not even an area of resistance. What happened? Prices came to the supply over and over again, and now this resistance is formed. But what created that resistance? It was that area of supply. Now if you think about it, again, this is a script which is making all-time highs, right? So in a script making all-time highs, ideally I would not be interested in planning shorts, but yes, as an aggressive trader, if you want to plan some shorts, you can do that. But what was telling me that I can plan my short trade? That's the price action. So that is what I was telling you, that we do have an advantage when we are looking at demand and supply concept, because even before everyone else starts seeing that maybe that markdown phase has started, probably you can be the first person to participate in those moves. So let's see if I can find a better example for you yep, I have a very beautiful example. Let's look at this example. Now if you look at this example, this was, I guess, a few weeks ago, where we had this beautiful area of demand. Let me mark this demand zone, and let me do this because I want this demand area to get replicated on other time frames. So I'll draw it again after enabling the replication, and let's mark this as our demand. And now if you look at this demand zone, this is where this demand was, right? Now at this given point of time, if I ask you people, what is the face of the market? Is it markup? Is it markdown? Or does it look like accumulation? Does it look like distribution? Give me your answers in the chat box. I'll wait for your answers for a few more seconds, because like I said, I know that the video is a little delayed. So give me your answers, and yes, I'll definitely answer all these questions which I can see are coming into the chat box once we are done with the topic we have on hand today. And this topic can be a little extended, so I'm trying to be as quick with this as possible. But yes, my question to everyone is, at this given point of time, what does this phase look like? Does it look like mark up, or does it look like mark down? Does it look like we are having accumulation, or does it look like we have distribution? So give me your answers in the chat box. A very simple question. You're just trying to understand the flow of the price and trying to take a wild guess what kind of phase probably this can be. So is it mark up, mark down, accumulation, or distribution? So give me your answers in the chat box. Let's see. So I'm not getting any answers by now, probably, maybe. Okay, so Sridhar says up. Perfect. So now I can see some answers coming in, because I understand that there is a little bit lag between what I'm talking about and by the time you see the same thing. All right, so some of you are saying markup, some of you are saying distribution. So in distribution, it has to be in a range, but can you see as of now we are not in a range? As of now we just have been moving up, so it cannot be distribution or accumulation, because in distribution, accumulation, you need to be trading in a range, which is not happening as of now. So definitely it is a phase which is markup. So when we have that markup phase, what are we supposed to do? Like I said, an example can be when we are in that markup phase, we will be waiting for prices to retrace, so that when I get my opportunities, now those opportunities can be based on some candlestick patterns. Maybe you're looking for some bullish candlestick patterns, which is your signal. It can be based on some trend lines, which can be something like this, that maybe you let me see if I can. Okay, so what I'll do is let me draw it using this itself, because I've never used trend line on this. So probably, maybe you mark a trend line which could be something like this, or maybe you have a trend line which is something like this, and now you're waiting for prices to come back to those trend lines, and those are your opportunities to go long. Maybe you're using some moving average, that I want prices to retrace back to a moving average, and that is where I would like to go long. Or maybe you're looking at area of support, that yes, I'm in a markup phase, let the prices come back to an area of support, that is where I would like to buy. But now if you think about it, we were in that markup phase, right? And that was the time we had this demand area, right? We had this demand area. And I told you that even though this looks one of the best looking demand zone, probably prices won't even give a bounce. It might just go right through it. And that is what happened. You can see when the prices, they came back, it still gave a bounce, but I was frankly was not even expecting a bounce out of it. So you can go through the recorded session, which probably would be the last to last Sunday, and that is where you will see I was talking about that I'm not even expecting a bounce. And can you see prices, they just went right through it. So even though you can see that the chart is telling me that we are in a markup phase, what was telling me that you should not be planning a long trade now? So that is again something which we have an edge when we are using demand and supply. So can you see, yes, you can use price action not just to identify your opportunities, but you can also use price action to understand when to use certain zones, when not to use certain zones. So this is where I'm showing you how the demand and supply methodology, it has an edge over anything else you're doing using price action. So this is one way where probably, I just showed you an example where if you're in a markup phase, you can use moving averages, you can use your support, you can use your maybe Fibonacci levels, you can use your trend lines maybe as your opportunities. Similarly, if you are in a markdown phase, we can take as an example maybe somewhere around here. So can you see we were in a markdown phase? So in that markdown phase, probably you can wait for some retracements to happen, and those can be your opportunities to plan short trades. So that is one example. Another example, to use price action to identify your areas where you would like to participate or to plan trades in a very mechanical way, can be your support resistance, right? And that is something we have already talked about in the previous session, how people identify support, how people identify resistance, and then they try to plan trades using that support and resistance. But what was the challenge with the support and resistance? That I proved to you that what creates that area of support and what creates that area of resistance. So can you see now when I'm talking about price action, I am talking about price action in terms of your areas of demand and supply, because your areas of demand and supply are also identified using price action. Now let me show you a few examples. I already have those examples with me from some of the recent sessions. Right now, can you see at this given point of time, probably if you're looking at the chart, let's say we were on this chart, you are probably looking at this chart maybe as a markup phase where you might be waiting for some corrections to happen, which you probably are using as your opportunities to go long. But what did I do? Can you see I planned a short trade? Now the reason I'm showing you this is because I also have a screenshot here available. Just give me a second, let me bring this up for you. So can you see this is Axis Bank. Now the screenshot which I'm showing you is the screenshot which I share with the students during the POS Plus course. So can you see, this was the trading idea for the 17th and 18th. So the session was on Monday, right, which is 16th, and you can see that the trading idea was shared on at around 4:28 p.m., which means after the markets they closed, I shared this trading idea for Tuesday, that Tuesday or after Tuesday, if the prices they come to this zone, just look at the zone is starting at 749.45, stop loss is 753.60, and target 1 is 474.15. Now can you see, this has been planned well in advance. Now if I go back, you can see this is my 17th. Like I said, this was planned on for the 17th session, because on 17th we'll be having the session in the evening. So this is for the next day. So this is where your 17th ended. And what happened, you can see that on the 19th prices came to that zone, just touched the zone and started moving back. Now if somebody was looking at it as a phase, which is a markup phase, what he or she probably would be doing is would be waiting for prices to come to some support areas or maybe to some moving averages, and they would be planning some long trades. But what was the advantage I had with demand and supply methodology? That I could understand that even though yes, it looks like maybe markup, we might be able to plan a short trade, because maybe distribution can start or maybe markdown can also start. And can you see, we entered here, we got a move which was almost 3:1. We were still looking for a 2:1. You can see the same day, which is 19th itself, we got a fill, we got a 2:1, we were done with the trade. But again, the advantage here is if I was using the indicators or the oscillators, they would have never given me that edge. What gave me that edge is that price action. The price action was showing me that yes, now here we have an area of supply where you can plan a short trade. Even though let's say it looks like an uptrend for us, it doesn't make any difference, right? Because we have an advantage that wherever we are using demand and supply, we are always one step ahead. Let me show you two more examples. Now can you see, this session was on 3rd of December, which is again on Tuesday. So Tuesday after the markets they close, we planned the trades. Now these trades were shared on Tuesday, which is 3rd of December at 4:12 p.m. right? So all the trades which I share with the students are always well in advance, and I share two different trading ideas. One is Adani Ports, which is a trade where the entry is 370.90, 370.370 is the stop loss, that's your target one, and also a trade on PEL where the entry is 1752.10, stop loss 1777.20, and 1701.90 is your target one. So if I now show you these examples, so first one is Adani Ports. Let's go to Adani Ports, ADANI Ports. So again, what you can see here is that the trade was planned well in advance. Now here, yes, maybe we are in that markdown phase, and that is where I wanted to plan a short trade. You can see prices came to the zone. Even though it looks like we got stopped out, but if I go back, you can see the stop loss was just 10 paise above, right? So let me bring that up. So can you see here the stop loss is for Adani Ports 370.90, right? So not 10 paise, 20-30 paise, right? So this is 373 point, oops, my bad. That's the entry. So if you talk about your stop loss is 373.30, right? You can see the stop loss was 373.70, which is just 10 paise above this. So can you see we were not stopped out? What happened? Prices they started moving down, and we got an amazing move, which was 1:1, 2:1, almost close to 3:1. After which, yes, prices again came back and the zone got violated. But one thing which I'm trying to show you is the advantage of price action. The advantage of price action is we are able to plan the trades well in advance, and prices they come back to the zone later. Now will it happen with each and every trade? Absolutely not. But what is the advantage? The advantage is our risk is always small, the rewards are always big, so that even if I'm right, let's say 50% of the times, I can still be a profitable trader. Let me show you the other example, which is Axis Bank. If you look at Axis Bank, this was on the 60 minutes time frame. So here also you can see we had this area right now. Yes, it probably looks like a markup phase, but we still planned a short trade. What happened? Can you see prices? They just touched the zone. We got a 1:1 move, we got a 2:1 move, we got a 3:1 move. We had a move which is almost maybe 3.5, And then today, in fact yesterday, which is Friday, prices, they started coming back and the zone got violated. But again, can you see, initially before the zone got violated, we were able to participate in this move to the downside. So what I'm trying to show you here is the advantage of understanding price action. If you can understand price action, in fact, the best example for you people is this one, the one which we just planned on Sunday. So can you see, on Sunday I marked this as an area of supply for you. So on Sunday we did not have any of these candles, and what happened today on Monday, the first test, the second test, and the third test, boom, prices are now just running away from that supply like anything. But what helped me understand that this is where we have a supply zone, right? It's the price action. And can you see, even the indicator is marking it as a supply zone for me. So this is one advantage of using price action, that if you are planning your trades based on price action, one, you're not lagging. Why? Because price action is always real time. Indicators are always lagging. And even when it comes to price action, it also depends upon what kind of strategy you're using. Now, I'll give you an example why demand and supply has an edge over, let's say, support and resistance, or let's say the four phases I was talking about. So let's assume if this is where I have my supply zone and this is where I have my demand zone. So if I'm in that markup phase, once the prices are in the supply zone, I know that now this markup phase can get converted into a markdown phase. Similarly, when the prices are in this demand zone, now this markdown can get converted into accumulation, and then prices can start moving up. So the advantage with demand and supply is that you just don't understand what phase you are in, but you also understand where this phase can change, which can help you plan trades in a much better way, and probably the first person to be in that trade versus when the rest of the people, they start looking at it as an opportunity. So yes, that is what price action trading is, where you're only using the charts. You're not using any indicators, you're not using any oscillators. By understanding the charts, now how you are understanding that chart, that completely depends upon your strategy. It can be, I gave you two examples, understanding the market phase. It can be understanding your support and resistance. It can be understanding the chart patterns. You're probably looking for double tops, double bottoms. But trust me, even if you talk about these double tops, double bottoms, head and shoulders, inverse head and shoulders, cups and handles, bullish flag, bearish flag, all these patterns, they also get formed because of your areas of demand and supply. So when you are doing demand and supply, you have an edge versus any other strategy you're using. And I just showed you a few examples of it. And it's not that, I'm showing you something which is before and after. That is why I do the Sunday session, so that you can see that the trades can be planned well in advance, and how the prices, they react from those areas later when the prices, they come back to those zones. And this is why the sooner you start focusing on price action, the better it would be. I know that if you have been using your indicators for a while, it becomes very challenging to remove them from your charts, but the sooner you do it, the better it will be for you. And that is the reason I showed you that beautiful example, that the indicators, they do not give you any edge. They are just showing what price has already done. It is not predicting the futures, it is just depicting the past. So now that we are done with this, let's quickly get started with the Q&As. So just give me a minute, I'll bring up the Q&As. Let's see how many Q&As we can cover, and then we'll end the session. All right, so doing great job, sir. All right, thank you so much, Pankaj. What is the perfect time to enter in the market? So the perfect time to enter in the market is when a particular trade setup matches with your trade plan, right? That's the perfect time. If a particular trade setup does not match with your trade plan, don't ever enter the market, right? So the perfect time is always an opportunity which is an exact replica of your trade plan, right? That's always the perfect timing, Rakesh. All right, so what time we should enter in market for intraday? So again, like I said, it has nothing to do with 9 o'clock or 10 o'clock or 11 o'clock or 12 o'clock. The perfect time is always when an opportunity is matching with your trade plan. Now, be that at 9:15, be that at 9:30, be that at 2:30, only when an opportunity matches with your trade plan, that's the perfect time to enter a particular trade. All right, so what price action you are talking about? So Sam, when I'm talking about price action, I am purely planning my trades based on demand and supply, right? So my price action strategy is to understand price action, to identify the areas of demand and supply. If you have not gone through the previous session, go through the previous session where we talked about the logic of demand and supply and the structures of demand and supply. So that will help you understand that how by understanding price action you can identify your areas of demand and supply, right? So that is what I was showing you as examples, all the trades based on demand and supply strategy. So Nifty looks in supply zone right now. Can it come down? So that's a very good question, Pankaj, that can it come down? Now the fact is, if you want predictions, only an astrologer can do predictions, right? I'm not an astrologer, right? I'm a trader. So a trader never does prediction, right? That is something you have to understand, that as a trader, if you start predicting the market, it's going to be very challenging for you to plan trades. As a trader, your job is to identify opportunities. If those opportunities match with your trade plan, take those opportunities. If they don't match with your trade plan, simply skip those opportunities. Now, if you're talking about, yes, prices are in supply, I would agree that yes, we do have that daily supply where probably the prices are. But I also added during the Sunday session that the conditions which I am looking for, those conditions are still not there. So can you see, I am looking for certain conditions, those conditions are not there. So does that mean that I should not be planning short trades? That completely depends upon your trade plan. Now can you see, I showed you that S&P 500 example. I told you this would be a very aggressive trade. If you want to be aggressive, yes, you want to plan that trade, there is nothing wrong with it. Did it work? Absolutely yes. But would I ever take that trade? No, because that trade does not match with my specific trade plan. So again, you need to understand that every trader has their own personality style. So some people are aggressive, some people are conservative. So your trade plan would also be based on your personality style. And if it allows you to plan short trades, yes, you can plan short trades. As of now, for me, as a conservative trader, I don't have a green signal to plan short trades on Nifty. But yes, as an aggressive trader, if you want to do that based on your trade plan, absolutely yes, you can do that. All right, what is the best time frame for intraday? So again, Rakesh, see, this is something I keep saying over and over again. People are always looking for what is the best time frame, what is that magic number, what is the best moving average, what is the best time. There is no such thing as the best time frame or the best indicator or the best settings for the indicator. The only thing is, or the only best thing is when a trade is matching with your trade plan, right? So when a setup is matching with your trade plan, that's the best time, that's the best time frame. Now once you're good with your methodology, it is not going to make any difference whether you're using a 5-minute chart or a 15-minute chart or a 30-minute chart. As long as you're not good with your methodology, yes, those time frames are not going to help you. But yes, coming back to as an intraday trader, because you don't want to be in that trade for a very long span of time, anything below 60 minutes, I'll say, is a good time frame to use. You can use 30 minutes, 15 minutes, 5 minutes, depending upon your comfort level, because the smaller the time frame, the faster the analysis, the faster trade management. The bigger the time frame, the slower the analysis can be, the slower the trade management would be. So you will have to find what is your comfort level. If you feel 5 minutes is good enough for you, you can do that. If you feel that 15 is better for you, you can use 15. But yes, once you start going 60 and above, probably getting the targets the same day can be a little bit challenging. So you will have to see what is your comfort level, but anything below 60 is a good time frame if you want to plan some intraday trades. All right, so there is a gap on 12K. So we'll not be getting into gaps, right, as of in these sessions. Can you please tell me how the ground rules of trading? See, again, Rakesh, if you talk about trading in itself, it's a very vast subject, right? There are n number of ways people, they plan their trades and they take their trades. So if you talk about ground rules, the ground rules would be, you need to have risk management in place. You need to have a strategy, which is a proven strategy for you. And you need to plan your trades in a very mechanical and rule-based way and try to avoid as much of emotions as possible, right? So these are the basic rules. But now the question is, based on what rules will I be making my trading decision? That completely depends person to person. Some people might be using moving average crossover, some people might be using Fibonacci levels, some people might be using trend lines, some people might be using, let's say, oscillators, some people might be using Bollinger Bands. So again, based on person to person, everyone can have a different strategy. My strategy is purely based on identifying the areas of demand and supply, and that is what I use. So when you learn the strategy, yes, I give you all the rules which are in connection with demand and supply, but that does not mean now you can use these demand and supply rules and start applying it to some other strategy. So the rules for every strategy will be different, right? So it cannot be one rule fits all. Every person, every strategy is a unique strategy in itself. and that is where the rules would also vary. But yes, the basic things which every strategy should cover is your risk management, your mechanical rules, and it should be a process where you can apply it in such a way that you are avoiding a lot of emotions and trying to make your decisions purely based on rules and not based on emotions. Alright, so that brings us to the end of today's session, and I'll do the same topic tomorrow, where again we'll be talking about what is price action trading, how demand and supply has an edge over anything else you're doing in price action trading, and why we should not be using indicators and oscillators. I showed you all those examples. And yes, until we meet next, enjoy your evening, take care. I'll see you very, very soon. Bye bye for now.